Hello, everyone. Welcome to our webinar on valuation. We titled it Behind the Numbers because we're going to talk a lot about valuations, and it's more than the number. The number is a measure, but it's the value of a business is more than just the calculation of return on investment or multiple of EBITDA, whatever you want to use. There's more to how valuation is done. So let me introduce our agenda for today and our company. Stony Hill Advisors is a M&A advisory firm, and we do business valuations as the purpose of today's conversation, but we also do exit value planning, and the key word there is value because when preparing a business for exit, the goal is to increase its value by reducing the risk factors that any buyer would be exposed to and effectively discount the value of the business. So the planning that we guide our clients through is all about improving the value of the business at the same time. And we also do intermediary services like selling a business and buying a business, being the agent for that transaction. Most of our activity is in the sell side, but we use the buy side activity to help a business grow, and that again adds back to the value and the purpose of an acquisition to an ongoing business owner is to grow the company rather than just wait for the organic growth. It's much easier to grow a business through an acquisition, and the financing of the acquisition is very affordable with interest rates still low, and the availability of funding is tremendous right now. We focus on in a marketplace of businesses between, roughly speaking, 1 million and 50 million in revenue. And that's a general category. Most of our clients are 2 to 30 million roughly, but we have had activity with bigger companies, and we have done business with 1 million in revenue and some even smaller in the past. And the key to what we do in our brand is our holistic approach to helping business owners access their wealth. And that goes back to what I said at the beginning. We help the business get ready, we reduce the risk factors, increase the value, and then find the buyer. There's 7 of us in the business, and we're scattered from Connecticut, where I'm located, New York, New Jersey, and you're going to meet 2 of my partners today, Fred Kaplan and Christy Lutz, who are in Pennsylvania and near the Philadelphia market and serving the Philadelphia region. And we also have someone in Ohio and in Western PA. But we cover business, we have clients nationwide. So these are just where we have individuals on the ground, but we can work with anybody, anywhere. So this is me, and I'll just turn it over to Fred and Christy in a moment. I founded the company in 2010, and we've been very successful over the last 12 years. My background, as you can see, I have an MBA and a certified mergers and acquisitions certification, and certified value builder, which is a method of increasing value, which we take advantage of in our coaching around exit planning. I'll let Fred and Christy introduce themselves. Their backgrounds are very, very strong, and I can't do justice by telling you about it. I'll let them introduce themselves. So this is our agenda. Now I'll pass it on in just a second. So we're going to start with dispelling valuation myths, and then talk about the steps to doing a comprehensive valuation and our methodologies that we typically use. These are general market methodologies, but we'll discuss why certain methodologies are better than others. And we'll introduce some things you may want to think about in terms of why you want to do that business valuation. There are multiple reasons to do one. We'll save time for Q&A, which we'll use the Q&A feature of Zoom. So please put any questions into the Q&A section, and we'll cover those at the end. And then we'll conclude with our next steps. So I'm going to turn over to Fred, and Fred Kaplan is a partner located outside Philadelphia, and he can introduce himself.
Thanks very much, Paul. I'd like to start going through 8 different, what I'll call myths of business valuation. These are some of the things that I hear from sellers when they're interested in obtaining a valuation of the business. And we thought it would be worthwhile to explain why some of the things you hear may not be true in the long run. So first, I want to tackle rules of thumb.
Fred, if I may interrupt, introduce yourself and give us some background on you.
Sorry.
I left it to you. If you want, I can do that, but
No, that's okay. So I'm Fred Kaplan. I reside in the greater Philadelphia marketplace. I have an MBA in finance, a certified business manager, and a certified mergers and acquisitions professional. I lead 2 practice areas for our firm, the food, beverage, hospitality, and professional services. Although maybe I'm not even going to say that because, we'll work broader. I think I'll scratch that. My background is in the world of companies from accounting and financial consulting. Been involved in a number of exits in my past. So I want to tackle rules of thumb. Rules of thumb are metrics that are designed to broadly estimate sale price. And you may have heard of these in terms of sale price equals 1-time sales, or maybe price equals 4 times EBITDA. While rules of thumb are sometimes used by valuators like ourselves as a sanity check after evaluating a business with other methods, it really is wrong to use a rule of thumb as the primary method of determining value. Principally because a rule of thumb assumes an average company in a specific industry, but every closely held business is not really average. You can't make an informed decision if you haven't considered all variables. No 2 businesses are the same, even if they operate in the same industry. Your company may have products or services that are broad enough to cross over into multiple industries. And even if your company does fit reasonably well in a single industry, its historical financial results and its future prospects probably vary from the industry averages in significant ways. For example, I'm now selling a brew pub in Pennsylvania, a company that is both a full-service restaurant and a microbrewery. While rules of thumb will reference historical multiples for restaurants and also for breweries, neither metric alone is really a fit for my client. Also, your business location, sales territories, regional economies are likely to have an influence on your company performance, reinforcing that the national median values of market multiples that you see in a rule of thumb are really not applicable to you. Second myth I like to talk about is that valuations use the same multiples for similar businesses. For a fair business valuation, one needs a deep understanding of the business and must consider all the company's financial and technical aspects, both large and small. Company's brand, expected growth rate, business model, business ideology, customer base, and other business contracts significantly determine business value. Since all these factors will differ for different companies, there can never be a standard multiple to assess business value. For example, 2 businesses can generate the same profit of $100,000, but one company generates that profit by spending $50,000 on materials, while the other may need to pay $75,000 to generate the same profit. Clearly, each one is different. So there's no standard multiple for an unbiased assessment of business value. Buyers base their value calculations on the expected return on investment. So if a buyer wants a 20 to 25% return on their investment, they will translate this number into a multiple of X when calculating the purchase price. Let's consider another example. Burger King and McDonald's are both well-known fast food brands. Each has its customer base, but this is where the similarity ends. Both brands have entirely different business models, which affect their valuation. McDonald's owns most of the land where its retail outlets are built, especially in premium locations, which is then leased as long-term contracts to franchisees. On the other hand, Burger King sells regional licenses to franchisees and maintains no control over individual storefront operations. So each franchisee controls the road. I thought I'd include a chart to help illustrate this issue. On the horizontal axis, we see company size, and on the vertical axis, we see sales price as a multiple of EBITDA. As you can see, market multiples clearly trend lower for smaller companies, higher for larger companies, and vary considerably by industry. Mergers and acquisitions professionals refer to a small company discount, which often applies because of the perception that small companies are riskier than large businesses. It's generally understood that larger businesses are more substantial and stable organizations because they found a way to grow beyond the efforts of the owners and therefore are less reliant on the owners. Larger businesses will also have more resources and access to both equity and debt financing. Because of all this, the size of your business affects your value. I thought you'd find this chart interesting because it reflects current information through the fourth quarter of 2021. The brown columns represent 2021 transactions, and the gray columns cover all time periods. EBITDA multiples remain the highest for asset-reliant businesses, specifically information sector and the mining and oil and gas sector, and are the lowest in the service sector of the economy, specifically in accommodations and food services and other service sectors. This is not surprising. Over the last 12 months, the median EBITDA multiple in the information sector was significantly higher than the historical median. This rise comes as a resurgence in the number of acquisitions of software and computer-related technology companies, where post-COVID-19 lockdowns, these technology companies have done a good job of adapting, evolving, and shifting more of their employee workload to remote work while maintaining their efficiencies. As a result, buyers are showing their confidence in these companies emerging following the pandemic. Conversely, the pandemic has negatively affected the healthcare and social assistance sector, as hospitals saw lower margins due to higher expenses and lower revenues due to fewer elective procedures. Over the past 12 months, the median EBITDA was much lower than the historical median. The EBITDA multiple for the manufacturing sector, which has been hit hard by supply chain and employment-related issues, has also been significantly lower over the past 12 months than the historical median. The third myth I want to dispel is that business value is solely derived from tangible assets. Value is multifaceted and includes intangible assets like brand reputation, trademarks, patents, goodwill, copyrights, etc. Intangible assets give specific rights and privileges to the business, which means they have value. While assessing the business, it's necessary to estimate the value of all its intangible assets. Often these assets are grouped as goodwill, but each is different and well-defined. Intangible assets may also be referred to as the company's secret sauce, something different and special that makes the business unique and prized by its clientele. Since these assets do not have a physical form, agreeing to their value is often the most significant challenge when selling a business. Another way of thinking about goodwill is in terms of excess earnings. Investment guru Warren Buffett describes economic goodwill as the value of a return in excess of market rates. In other words, your business creates goodwill or a premium value above the value of identifiable assets if your company generates returns that are higher than others in your industry. The fourth myth I'd like to discuss is that valuation only looks at today's numbers or even historical numbers. Unless you're selling your business based on its adjusted net asset value or book value, the past performance of the company is relevant in a very strict sense. A buyer is not purchasing your company based on what it has done in the past, but on what it can do in the future, essentially the viability, stability, and predictability of future cash flows. Since you are selling future earnings of the business, past performance is only meaningful because it can help predict future results, if it identifies a trend that is likely to repeat. All things being equal, the more consistent your past performance, the easier it will be to predict the future prospects of the company. And the more confidence a buyer has in the projection of the higher price he or she will pay for those anticipated future earnings. This is why some companies that don't even earn any income at all still trade at a high multiple, because there is a great deal of confidence in their future performance. Later in this program, Christy will show how both historical financial results and future projections are used in performing valuations. Number 5 is that valuation amount is the same thing as purchase price. And this is just not true. In business valuation, the purchase price is the total amount the buyer is willing to pay. The purchase price may be higher if the buyer needs working capital, and may be reduced to cover debts of the seller that are deducted to reach the business's equity value. Business valuation is really a baseline figure. It does not guarantee the purchase price. The purchase price is only one aspect of the transaction, as the deal structure affects the final figures. Several elements have an impact on the deal structure, including the down payment, is it an asset or a stock sale, seller financing terms, specific terms of property used for business owned by the seller, provisions for post-transaction clawbacks in order to protect the buyer from customer attrition, availability of capital for the company and its new owner, debt service coverage ratio limits imposed by a lender, and short-term capital needs. Additionally, if you're selling only a portion of your business, a minority or non-controlling discount may be applicable to the transaction. Because a minority shareholder does not have the same rights as the majority shareholder regarding business operations, strategy, and setting compensation, nor can dictate the amount and timing of returns on their investment, the transaction price for a minority position may be materially less than the pro rata share of the total business value. And lastly, also affecting the purchase price will be taxation details affecting both buyer and seller, especially if deferred payments are included. Another myth I often hear is that having low expenses and low debt is always good for your business value. But low expenses may mean that you're not reinvesting enough in your business, leading to a stagnation in value. When you reinvest in your business, you actually reinvest to increase revenue and profit. Moreover, when you pour capital back into the business, it contributes toward increasing your customer base, adding new locations or product and service range. Reinvesting also means upgrading your business by improving operations and updating your operating systems by investing in technology. Such improvements will contribute toward a better valuation. I often see tax returns that show little business taxable income. This may be good for tax planning, but it backfires for exit value planning. A buyer wants a business with robust cash flow, not one that breaks even. As Christy will show you, lower reported EBITDA lower your valuation when compared to similar companies. This is why professional valuation analysts will add owner compensation and related benefits back to reported EBITDA, creating a seller discretionary earnings figure. This is done because the owner of a privately held company has discretion over whether to leave profit to reinvest in the company or take it as compensation. The SDE, as it's known, represents the free cash flow that a buyer would receive, with discretion to spend on compensation or reinvest in it. Number 7 is that all value is relative. When asked how much something is worth, many people will answer that the market value is whatever someone will pay for it. Well, even though there's no precise value for a given business interest, we do not subscribe to the premise that, like in the case of a work of art, that value is completely subjective. Companies do have an intrinsic value based on the future economic benefits they can provide. As we already discussed, the value of the business will vary greatly from one buyer to another based on their individual expectations of future performance and assessment of risk associated with those expectations. But a buyer will expect to receive their initial investment back with a reasonable return over a fairly short time frame. Another important issue is whether a seller's accumulated goodwill is transferable to the buyer. If goodwill is personal, client relationships, or owner industry prominence, that value may not all transfer to a buyer. Your sweat equity and emotional attachment to the business, the baby you founded and nurtured to success, may not hold the same value for your acquirer. The key to making goodwill saleable is to institutionalize it so it becomes goodwill of the entity, not of the individual. In other words, clients need to become customers of the firm, not of a specific person. Knowledge needs to be shared and documented so that business flourishes without the owner. The goal of a seller should be to maximize the transferable value of the business. Be aware that you might have a very profitable business that is only successful due to your own efforts. And lastly, I want to dispel the notion that all businesses are saleable. Now, there are some businesses that operate for a long time without ever paying the owner a return on his or her investment. Sure, the company has paid the owner a salary. Unless that salary and other benefits exceed the market value salary for what the owner is doing on a day-to-day basis, the owner may just be creating his or her own job. If you own a business and work in it, you're entitled to both a reasonable salary for the work you perform as an employee and a reasonable return on your investment. You probably expected to make a fair return, but what if it does not happen for you? Why would someone else make the same investment? When you think of it in this way, it's easy to see that not all businesses are saleable. You can also consider it in terms of lost opportunity costs. What other investments could have been made with the money you initially invested in your business? What could have been done with earnings you left in the company? And what returns would have been received on those investments? For example, I could invest in the stock markets and reasonably expect a 10% annual compounded return over 10 years with little risk. In order to buy a business with many more risks, I would expect a higher return. And some businesses are just not saleable simply because they're less expensive to start from scratch. In these cases, there's no real benefit to acquiring an existing company when you could start it. Nobody else did. Now I'd like to turn over the program to Christy, who will drill down on several elements of our valuation process. And I want to just give a quick overview to lead into that with what our process is. She'll talk about how we renew financial statements and company documents, interview management to learn the intangibles that make your company different from the market averages, kind of research that we do into precedent transactions, the analysis and calculations that we do, our quality control process, which results in delivery of a draft report and ends with questions and answers with our client regarding the methodologies and approaches that we chose and how we weight them in order to fit your individual company's characteristics.
Thanks, Fred. Good afternoon, everyone. I'm Christy Lutz. I have my MBA in Finance and Entrepreneurship. I've been with Stony Hill since 2017, but my entire career prior to Stony Hill has also been involved in mergers and acquisitions in a variety of different industries. So I'm going to take you through the steps to a completed valuation, and I'll dive into each one of these steps as we proceed through the presentation. So after our initial meeting with management and conversations with the owner to complete the valuation, the first step is always to analyze the financials of the company. So we will request from the business to receive at least the first or the last 3 up to 5 years of the business tax returns and the internal financial statements, such as the profit and loss and the balance sheet data. We want to analyze all of the financials in the business because we want to understand the different trends within the operations that, are you frozen? You're not moving forward. Okay. We want to understand the different.
Go to the income approach first. Okay, go ahead.
Nope, you're good. We want to understand the different trends within the business and how it compares with the industry benchmarks. We want to also analyze the financials to understand what adjustments will need to be made to the seller's discretionary earnings and the EBITDA figures, which is the basis for the majority of the valuation. The bottom line is we need to present a true picture of what the actual business does at the end of the day to generate the cash flow figures that a buyer can expect to receive. Once we have done our financial analysis and determined our SDE and EBITDA adjustments, we'll start to consider which valuation approaches we're going to use. Will we use the income approach, which is based on the future cash flows that the business generates? When considering this approach, we want to understand the reliability of those future projections in order to determine if this approach is viable or not. We'll also consider the market approach. And the market approach is primarily based on historical and current transactions that have occurred in the industry and comparable companies and how the comparable companies are trading. The determination of this approach is really based on the availability of this data to determine if this approach is viable or not. We'll also consider the asset approach. The asset approach is primarily based around valuing just those hard fixed assets. So when considering this approach, we'll want to determine if it's a heavy asset business or if there is goodwill within the company, such as the customer lists, the brand equity within the company that also adds value that we need to consider. So once we've determined which approaches we would want to use, we'll start working with the company to consider some of the qualitative adjustments to these methodologies that we'll consider, which are based solely on the subject company's operations. And then finally, once we have all of these pieces analyzed and calculated, we'll reconcile all of this data to arrive at our valuation conclusion. So the first step, as I indicated in our financial analysis, is to go through the financials with the company to understand which adjustments we're going to make to the SDE and the EBITDA. The first thing we do is to obviously identify the typical adjustments, such as interest expense, income taxes, depreciation, and amortization. That makes up your bottom line EBITDA. From there, we'll start looking at the additional adjustments to increase the cash flow. Some of those will include owner salaries and bonuses. Owner salaries are often higher or lower than the regular salary that would be paid to a third-party manager. Also, when owners manage the business, a bonus may be declared at the end of the year to reduce income taxes. This bonus and any extraordinary owner salaries need to be added back to calculate seller's discretionary earnings. And then an estimate of the third-party manager compensation would then be assumed to arrive at your adjusted EBITDA figure. In addition to the owner salaries and bonuses, we'll also analyze the financials for any one-time or extraordinary expenses within the business, such as professional fees. We'll look out for expenses incurred that relate to matters that do not recur in the future. An example would be legal fees a business may incur in settling a legal dispute. Not only would you add the settlement expense back to EBITDA, but you would also add back the related legal expenses. The same applies for accounting fees. If, for instance, one particular year, the IRS decided to audit the financials of the business and you had increased accounting fees during that particular year, those would also be added back. There could also be special transactions or marketing costs if you did a one-time marketing campaign. The key is to identify any of these one-time, non-recurring expenses that are not performed in the ordinary course of your business. Another common area we see that needs to be adjusted is the rent at the facilities. Many companies do not own the facilities they occupy, but instead rent them from a holding company owned by the owner of the business. This is similar to a related party transaction that needs to be adjusted, but single it out as a separate point given how frequently it occurs. I gotta change my notes there. The rent is often arbitrarily set above the going market rent. Therefore, the EBITDA would need to be adjusted upwards by adding back that arbitrary non-arm's length rent and subtracting the true market rent. Other expenses that we might want to, other revenue and expenses we might want to analyze would be revenue and expenses that are generated by redundant assets, other non-arm's length revenue or expenses, rent and maintenance expense that typically should be capitalized, and any excess inventory that has been purchased in the cost of goods sold that is not completely necessary, but is purchased in order to reduce the tax liability within the business. So now we'll discuss which valuation methodologies are available to analyze and what they really mean. So the income approach, as I mentioned before, is directly related to the present value of all future cash flows that the business is reasonably expected to produce. This requires estimates of future cash flows and then an appropriate rate at which to discount those future cash flows. Commonly used methodologies include the discounted cash flow and the capitalization of earnings method. In the market approach, we use that to determine the value of a business by considering the market prices of comparable assets or businesses that have either been sold recently or are still available on the market. Within that methodology, we'll consider comparable transactions and comparable public companies. And lastly, the asset-based model is a form of valuation in a business that focuses on the value of a company's assets or the fair market value of its total assets after deducting liabilities. However, as I mentioned previously, this does not take into account the goodwill within a business. So for our purposes today, we're going to focus on discussing the three most commonly utilized methodologies in business valuations. That's including the comparable transactions, the comparable company, and the discounted cash flow methods. In the comparable transaction methodology, we will do market research to determine the most recent transactions that have occurred within our subject company's industry within the last 3 to 5 years. We like to go only about 3 years back, but again, depending on the availability of data, we could go back 5 years to obtain appropriate amount of transaction data. From there, we'll also analyze these transactions to find them the target companies that are most comparable to our subject company. With that, we'll to look at their revenue. As Fred mentioned earlier, size does matter when it comes to valuation. So we'll want to analyze the transactions that have a target company where the revenues are primarily related to our subject company. We may also look into geographic considerations. For instance, if we're analyzing a landscaping company in the green industry, companies that transacted in the Northeast of the United States are going to be valued very differently from companies that are based in the Southeast. And then lastly, we'll also want to consider some of the financial metrics of the companies that have been previously sold, such as their SDE margins and their EBITDA margins, to find companies that operate most similarly to our subject company. Once we have a good basis of transactions to analyze, we'll calculate our pricing multiples from a price to SDE and a price to EBITDA basis, and apply those multiples to our subject company's adjusted SDE and adjusted EBITDA over their historic period. We'll also provide a sensitivity analysis so that the business owners can understand how their value will be impacted at different multiples that a buyer may utilize. The biggest drawbacks with this methodology, however, is that no two companies are identical. So we really have to analyze the operational, financial, and market factors that could have been at play during when these transactions occurred and within the target companies that were acquired. And then lastly, the other drawback is, again, the accuracy of the data we were able to determine. Because these are all private transactions with primarily private companies, the data is not necessarily publicly available. And therefore, we have to consider the accuracy of the data that is available. In the comparable companies methodology, we develop a value based on consideration of publicly traded companies that would provide a reasonable basis for comparison to our subject company. Now, this data is all public, which is great. However, we also have to consider how comparable the public companies are to our subject company, and again, how much data. Once we compile the financial data on the public companies, we then calculate our pricing multiples again. And in this case, we'll calculate enterprise value to revenue and enterprise value to EBITDA. Once we have these pricing multiples, we have to apply a discount factor for our valuation of the subject company, primarily due to risk. Public companies are generally considered to be less risky than private companies, number one. There's also control risk to consider in that private companies typically have owners versus a public company that has thousands of shareholders. And we have to consider marketability risk in the fact that you can easily buy and sell shares of a public company, but the sale of a private company is much more complex. And then, of course, you have to consider your size risk. Larger companies, again, less risky than smaller companies. And the biggest drawback, again, with this particular methodology is that there may not be sufficient public companies in a particular industry in order to analyze for the appropriate amount of data. The discounted cash flow analysis is based on the theory that the value of a business is the sum of its expected or projected future cash flows that is then discounted at an appropriate rate. The three key drivers within this methodology are those future projections, the residual or terminal value at the end of the projection period, and that discount rate. We typically like to provide a projection period that's at a minimum 3 years and up to 5 years, and most often we'll utilize 5 years of projections. Ideally, these projections would be sourced from the business owner, but if projections are not available, a forecast based on the historical performance, industry benchmark data, and further discussions with the owner can be developed. This is most commonly used for larger business methodologies where the projection period can be more easily obtained due to the fact that they have more sophisticated financial processes in place and they've been established for a number of years. The discount rate is essentially the required rate of return that a buyer is going to have based on the level of risk they are receiving for that amount of cash flow at the time anticipated in the projection. The higher the discount rate, the higher the risk. Hence, it's usually used again for larger companies. The basis of this methodology is that we would expect the buyer to pay more now in anticipation of big future gains. And the biggest drawbacks with this methodology is the reliability of the projections that we're utilizing and the uncertainty around the future market and economic factors that could take place in the future that could have an impact on those cash flows we are projecting. So we have two companies here, Company A and Company B, both very similar in that they both operate in the B2B services industry. They're both about 10 years old. They both generate $10 million in revenue. However, the remaining factors with the companies are very different in how their business models are developed. So in looking at these two companies, which company do you think is worth more? And we're going to have you take a poll to get your opinions on the matter. I don't think you can do the poll in this Zoom.
I can't. Yeah,
Okay.
Yeah, it's because we're not in a webinar session.
Right. Okay, it looks like the majority of you think that Company A is probably worth more. However, we have to consider what a buyer is actually going to be looking for in a target company they're looking to acquire. And in this particular case, we would expect Company B to actually be worth more to a buyer due to a lot of the qualitative factors that we'll be discussing next. And with these qualitative factors that we have to analyze in a business, That is why we feel that, next slide, that valuation is actually more of an art than it is science. Some of the qualitative value drivers within a company are outlined in this slide. Number one, obviously, is financial performance, your revenue and profitability as it compares to the different industry benchmarks. How are you performing against your peers? And while you may not believe so, your record-keeping processes are also considered a qualitative value driver. Do you get audits done on your financial statements? Or are they reviewed by a CPA? Do you use a QuickBooks program to record your internal financials? Or do you bring a shoebox full of receipts to your accountant at the end of the year? Believe it or not, that has a big factor in terms of increasing your value or decreasing your value, depending on how sophisticated your record-keeping processes are. Growth potential. What are the opportunities for growth within your business? Can you add another service line? Can you expand geographically? And at what rate can you grow the business? Do you have enough capital within your business to invest in growth for the future? Operational dependence. Do you have one key employee or a couple key employees within your business that if they were to leave your company to work for somebody else, it would be detrimental to the operations? Customer concentration. Do you have a customer within your business that makes up more than 20% of your revenue, that if they would leave to purchase products or services with one of your competitors, again, it would be detrimental to the revenue within your business? And supplier concentration. Do you purchase your supplies and materials from one supplier? If that one supplier were to go out of business, where are you going to continue to maintain your operations for purchases with materials and supplies? Your cash position. Do you have substantial working capital within the business to cover your expenses in slower periods or when you are out of season? Or do you have to rely on a line of credit from a bank to cover those necessary expenses that take place throughout the entire year? Recurring revenue. Recurring revenue is highly valued by buyers. And when we talk about recurring revenue, we refer to recurring versus repeat revenue. So repeat revenue is a customer that will repeatedly make purchases from you, such as when you go to your favorite restaurant a few times throughout the year. Recurring revenue, however, is an automatic revenue stream that is generated. For instance, a gym membership. Every month, that membership fee comes out of your bank account, whether you go to that gym or you don't. That recurring revenue provides a predictable stream of future performance for a buyer and therefore is highly valuable. Competition. How do you differentiate yourself among your competitors? Do you operate in a highly fragmented industry where there's low barriers to entry? The key is to really find a way to differentiate yourself from the other peers and competitors in your market so that people will choose you over somebody else. Owner involvement. This is a big one. Are you an absentee owner or an owner operator? An owner operator is an owner who is directly involved in every facet of the business, from customer development to business development, to being the face in front of customers, to being involved in all of the operations, and then also handling all of the books and records. It's important to have a team in place that can help the owner to manage all of these other facets and to become an absentee owner. An absentee owner is somebody who can easily go on vacation and the business is not going to fall apart. And then lastly, customer satisfaction. What are your reviews online? Do customers appreciate what you provide and come back to you over and over again? Are they referring you additional customers? Believe it or not, everybody's got an opinion out there. So what do your Yelp reviews look like? Once we've analyzed all of the different methodologies, from the precedent transactions to the comparable companies to the discounted cash flow, and then also analyzed all of those different qualitative value drivers, we put all of these pieces together to arrive at our subject company's implied valuation range. This valuation range is then displayed in what's called the football field. And the different methodologies are weighted appropriately based on where we find the methodology to be the most appropriate for our subject company. Now I'm going to turn it back over to Fred, who's going to go through some of the reasons for obtaining a business valuation.
Thank you, Christy. It may be hard to believe, but a recent survey showed that 98% of business owners do not know the value of their business. And there are a number of reasons why this is really important for you as a business. Understanding the current and potential value of your business is one of those things you can gain from evaluation. As Christy mentioned, not only do the financial numbers drive your value, but understanding those intangibles drive the value too. And by going through a valuation process, you can learn what intangibles can be addressed to help drive further value. The business sales process and the lending process generally require the valuations be completed. And if these events represent the first time an owner has a valuation done, then you can be sure that critical business and estate planning issues have not been addressed. If the business is to have a life beyond that of its current owners, then effective planning for ownership transition requires a regular valuation of the business, right? Know the value of your largest asset so you can plan for your own retirement. Not just because you need to know the value for a sale or for funding opportunities. Ownership transition may include gifting some percentage of ownership shares. Next slide, Paul.
Okay.
Ownership transition may include gifting some percentage of ownership shares to family members during the owner's life, thus reducing any tax on the owner's estate at death. If a firm has several owners, a buy-sell agreement with accompanying life insurance should be in place, so that if an owner dies, the remaining owners have sufficient funds to purchase the deceased owner's interest at an agreed-upon value. The buyout value under these agreements should be updated regularly to reflect the firm's financial progress over time, and the valuation approach used should be one of several that are acceptable to the IRS. Next,
Okay.
I'd like to, or that, you want to take this, or I could just say that concludes our prepared remarks, and we'd like to use our remaining time to answer questions from those in the audience. So if you have a question, please put it in the chat room, and Paul will moderate those.
Yes, put the questions in the Q&A section, and that way I don't have to go back and forth. So after we take turns answering questions, I'll take to the next slide and talk about the next steps. So we hopefully have given you a good understanding of the evaluation process and why it's important to have evaluation done on your business. Most business owners, the majority of their net worth is in the business, and it's important to know what you value, what your the value of your business and your personal assets, and how do you put them together. So we're going to offer a special consideration here to anyone who wants evaluation. Our normal pricing is $5,000 for a value evaluation report, and we'll offer a discount to 4,000. So if anybody's interested, please send us a message on info@Stony Hill Advisors, and we'll get back to you and schedule the conversation and get started.